Hello, this is a recording on the module FIN2601. So we've been going through this module and to date we've covered some key study units. We've looked at study unit 1, 2, 3, and 5. We briefly talked about an introduction, the role and environment of managerial finance. We also looked at financial statement analysis. We touched on the time value of money, and we also looked at interest rates and bond valuation. So this is what we've covered so far. Today I am going to take you through study unit 4 completely, risk and return. I'm going to take you through this whole study unit, and then in the last recording I'll take you through share valuation, and then we'll start looking towards the exam. Okay, and then we will be finished. So in the previous recording, I gave you some questions to practice. I gave you questions 34 to 40 to practice as homework from May, June 2019, question 34 to 40, right? So I will take you through these questions, question 34 to 40, and then I will start looking at study unit 4, right? So I looked at study unit 5 before study unit 4 because study unit 3 and 5 involved using the financial calculator. So question 34 from the multiple choice section of May, June 2019. We were given a bond with a maturity of 14 years, coupon rate of 8%, yield to maturity of 10%, par value of 18,000, and we were told the bond makes semi-annual payments and they wanted the price. I won't spend a lot of time here. You just need to be careful. Make sure you say 14 by 2, then you press N. 10 divided by 2, then you press I over YR. 8% times, okay, let me just do this example. I think I'll just do example 34 just to remind you, and then I'm sure you'll be able to do the other examples by yourself, but I'll just remind you again. Remember, we take our calculator and we clear it, then we say 14 times 2, this is N. We say 10 divided by 2, that's our interest. And then we say 0.08, that's 8%. So this coupon rate is the only one we put as a decimal, times the par value divided by 2, that's our PMT, 18,000, that's our future value, that's the par value. Then we press PV to get the price. Okay, so that's how you get that answer. And then question 35, it was also just a simple time value question. You can also just practice this one. It was a 0 coupon bond, so there was no PMT. We just take N as our 10, 7 as our I over YR, 2000 is FV, and then we get our PV of 1016.70, right? It's just a matter of putting into your calculator 10N, 7 interest, 2000 is your future value, that's the par value, then you press PV for the price, and we don't take the negative, remember. There was also question 36, a very simple one, straightforward. Question 36, Miracle wants to buy a bond with a 3,000 Rand par value payable in 4 years' time. The bond pays 6% coupon and is currently selling for 2,000. Yet again, 3,000 FV, 4 years in. This, remember when you're calculating a PMT, you put the percent as a decimal. 0.06 times 3,000. Let me just illustrate that on the calculator. Remember, we say 3,000, that's our future value. 4 is our N. Then we say 0.06 times 3,000, that's our PMT. And then 2,000 we put as a negative, that's our PV. Then we calculate our rate, which is 18.52. Okay. Right. So question 37, they wanted a coupon rate. Remember, coupon rate is equals to the coupon divided by the par value. So in this case, we just take our FV as 13,000, our PV as minus 13161, as 6 is our N, 14 is our I over YR, then we get PMT, then we divide that PMT by our par value to get the coupon rate. Question 38, this I'm going to cover today. If you did it, it's fine, but if you didn't do it, I'm going to illustrate to you the concepts involved with regards to question 38, how you calculate a nominal interest rate. I'm going to take you through this today. Question 39, this was just some theory. The correct answer is option 4. Remember, when the price of a bond is equal to the par value, it means the yield to maturity is the same as the coupon rate. And lastly, question 40, an upward sloping yield curve means that it's going to be more expensive to borrow in the future than today. So it means interest rates are expected to increase in the future, which is option 2. Okay, so that was the work I asked you to look at. Any query there, please let me know. So today I'm going to touch on risk and return, which is study unit 4, and then after that we'll be left with one last study unit. So let's go through the study unit. So in the study unit, we look at two important items, risk and return. And we define risk as follows. You have to know the definition of risk for the exam. Risk is the chance of financial loss. Risk is the chance of financial loss. That is, we can also define risk as the variability of returns associated with an asset. So if we invest in an asset and there's a high chance that the returns can be very variable, meaning that we can make losses, or rather the returns can be variable, meaning the returns are very unpredictable. Another way to look at it, risk is the unpredictability of returns. So it's the variability of returns associated with a given asset. And in finance and investment in general, the greater the risk associated with an asset, the higher the required return. Investors usually require a higher return for any assets which are associated with higher risk, right? So this is also, I've seen it before asked in exams. So sometimes you might actually be asked to determine the rate of return earned on any asset over a given time period. You might be asked to obtain the rate of return earned on any asset over a given time period. And to determine the rate of return earned by any asset over a given time period, we use the following formula. It's an important one, it comes a lot in exams, where RT is the actual expected or required rate of return during the period. So this is the rate of return we'll be calculating. We can call it an expected rate of return, an actual rate of return, or required rate of return. CT, this is the cash flow received from the asset investment in the period T minus 1 to T. So this is the cash flow that we get from the asset at the time we were holding the asset. PT, this is the price of the asset at the end. Here they just say price of the asset at time T, but you can also write this as price of the asset at the end. And then PT minus 1, this is the price or the value of the asset at the beginning at time T minus 1. Okay. So let me illustrate this to you through an example. I'm taking an example from October, November 2019, question 32. This is an example of where this formula can apply to get the rate of return on an investment. An investment of 160,000 Rand was made 2 years ago, right? So this is the value in the past. In the meantime, increased to a value of 190,000, right? So this is the value today, and has delivered cash flows of 30,000 Rand worth of dividends. What is the return on the investment? Okay, so they want the return on. So as I've said, we can rewrite this formula. Even if you write it in this way, you'll get the answer. If you write it in the way I wrote it, the answer will be the same. So we take the value of the investment at the end, which is 190,000, that's today at time t, minus the value of the investment at the beginning, that's 160,000, plus the cash flows that we got from the investment, the dividends, plus 30,000. And then we divide that by the value of the investment at the beginning, divide that by 160. So on the top part, we get 60, the bottom part is 160, and if we divide, we get 37.50, which is option 3. Okay, so this is an important question that comes a lot in exams and assignments. Remember, the rate of return or the return on an investment when they've given you the value at the beginning, the value at the end, and the cash flow associated, we just take the value at the end minus the value at the beginning plus the cash flow divided by the value at the beginning. So this is the first calculation you need to know in the study unit. The next thing you need to note in the study unit are what we call risk preference behaviors of different investors. So different investors or different individuals look at risk in different ways. So we have 3 types of financial managers or 3 types of investors. We have risk-averse financial managers or risk-averse investors, risk-neutral, and risk-seeking. So you have to know what each of these mean when we say that an investor or a financial manager is risk-averse, risk-neutral, or risk-seeking. Risk-averse means the attitude of that investor toward risk, in which investments would require an increased return as a compensation for an increase in risk. So when a financial manager is risk-averse, it means they require an increase in return whenever risk increases. In simple words, a risk-averse financial manager is a manager who requires an increase in return for an increase in risk. A risk-neutral financial manager, right, is a manager who requires higher return irregardless of the risk. So this financial manager doesn't really need return to increase corresponding with the risk. So here we say the attitude toward risk in which the investors choose investment with higher return irregardless of risk. So a risk-neutral financial manager will just always go for an investment with higher return irregardless of what the risk is, whether the risk, whatever the risk is, they just target investments with higher return. And then lastly, we have a risk-seeking manager. So the attitude toward risk in which an investor prefers investments with greater risk, even if they have lower expected returns. So a risk-seeking financial manager is prepared to accept lower returns, even if the risk is increasing. They are just seeking risk. Even if the greater risk comes with lower returns, they are prepared to accept it. So you need to know these 3 definitions. Risk-averse, you require an increase in return when risk increases. Risk-seeking, you just constantly seek out risk, even if that means a lower expected return. And then risk-neutral, this means you are indifferent towards risk. You will seek investments with higher return, irregardless of what the risk might be. Okay. So make sure you know those definitions. The next important, very important item you need to note in the study unit is calculating expected return, standard deviation, coefficient of variation, and the variance. Okay, now this is very important, and it comes almost in every exam with a lot of marks. So some of these are measures of risk. The range is a measure of risk. It was supposed to be on this list. You have to know how to calculate the range. The range is simply given by the highest return minus the lowest return. So if you're given some possible returns from an investment and you're asked to determine the range of the investment, you just take the highest value minus the lowest value. So that's how we can measure the risk associated with the investment. We can also measure the risk associated with an investment using a measure known as the variance, and I'm going to show you how to calculate the variance through an example. We can also measure the risk of an investment using a measure called the standard deviation. I'm also going to show you how to do this through an example. So these are very important. And lastly, you have to know about a measure of risk known as the coefficient of variation. And I'm also going to show you how to do this through an example. So I'm going to illustrate how to calculate these three through an example. And please note there's an important relationship. To get the standard deviation, we first have to calculate the variance. And then if we find the square root of the variance, that gives us the standard deviation. So please note there's an important relationship between the variance and the standard deviation, right? The standard deviation is simply the square root of the variance. So it's better shown through an example. Let me illustrate to you how you would calculate the standard deviation and the variance in a question. And I'll also show you the formulas through a question. So I'm looking at October, November 2019, section B, question 2 as an example. An investor, Sikulu, is considering investing in a new software venture company. However, the rate of return is to be realized next year. The rate of return to be realized next year is likely to vary depending on the actual economic climate that occurs. Below possible economic outcomes, the probability that each one will occur and the rates of return, rates of return projected for each outcome. So we have a project that this investor wants to invest in. And then there are three possible economic climates. They might be a recession, normal growth, or rapid growth. The probability that there's a recession is 0.25, meaning there's a 25% chance of a recession. The probability of having a normal economic climate is 0.5, meaning there's a 50% chance of that. And the probability of a rapid growth economic climate is 0.25, which is 25%. If there is a recession, the return will be minus 20%. If the economy is normal, the return will be 15%. And if the economy has rapid growth, the return will be 30%. So here, you are asked to calculate the expected return, the expected rate of return on the software venture, right? And then after that, you're asked to calculate the variance and the standard deviation of the rates of return of the software venture. And then lastly, calculate the coefficient of variation of the rates of return on the software venture. If the coefficient of variation of return for Sikulu's prior venture investments was 1.5, would the software venture be considered as being less or more risky? Okay, so let's work through that. So to calculate the expected return, you use the following formula right here. And basically what this formula is saying, we simply take each return, we take the return in state I, and we multiply it by the probability in state I, and then we add them up. In other words, we are going to look at all these returns and all the associated probabilities. And then we're going to say 0.25 times minus 20. You see, 0.25 times minus 20 plus 0.5 times 15, 0.5 times 15 plus 0.25 times 30%, 0.25 times 30%. and that gives us 10% as our expected return. Please note, when you are doing this calculation, it's advisable to put the probabilities as decimals and to leave the returns as percentages. You'll see, fortunately in this question, the values were given like that, so they made it easier for you. They gave you the probabilities as decimals and they gave you the returns as percentages. But let's say both of these were percentages. It's advisable to always change your probabilities to be decimals. Let's say they were given as percentages, these probabilities. You would just divide each of them by 100 to change them into decimals. That will make the calculation easier for you. So this calculation would then proceed as follows. So this is how we would do it. I just want to illustrate it to you through the calculator, right? So you would just say 0.25 multiplied by, open bracket, minus 20. So the return you can leave as a number, there's no need to divide that, plus 0.50 times 15. Okay, let's just make sure we put this in brackets in case there'll be negative sometimes, plus 0.25 times 30, right? And we get 10% as our expected return. Okay, so that's how we got it. So that's how you calculate the expected return. This is the return we expect to achieve from the investment. And then we were asked to get the variance and the standard deviation. Remember, before you can get the standard deviation, you have to find the variance first, and then the square root of the variance gives us the standard deviation. The formula for the variance is given by this right here. This is the formula for the variance. So let's briefly explain what this means, right? So this formula says we take each return and we square it, then we multiply that squared return with its corresponding probability, and we add them all up. So you take each return, square it, multiply with its probability, take the next return, square it, multiply with its probability, add them all up, and then you subtract your expected return in brackets squared, and then that will give you the variance, right? And then the square root of that variance will give you the standard deviation. Okay, so we say minus 20 squared times 0.25 plus minus 15 squared times 0.5 plus 30 squared times 0.25, right? Minus the expected return that we got here, minus the, and so you always have to get the expected return before you can get the variance or standard deviation. Minus 10% squared, and then that gives us the variance. And then the square root of the variance gives us the standard deviation. Okay, so I can illustrate this to you through the calculator, right? So you can say, once again, you can leave the return as it is. There's no need to change that, but always make sure you put your probabilities as a decimal. Then we take 15 squared times its corresponding probability plus 30 squared times its corresponding probability, right? And then we subtract our expected return, which is 10 squared. That gives us the standard deviation. And then so that gives us the variance. And then the standard deviation is the square root of the variance, the square root of that answer we got. We use this function, and it gives us 18.37%. Okay, so that's how we do that. And then lastly, we were asked to calculate the coefficient of variation. Now, the coefficient of variation is simply given by the standard deviation over the expected return. So we're simply taking this standard deviation that we got and we're dividing it by the expected return. That gives us the coefficient of variation. And then we were asked to compare this coefficient of variation that we got with the coefficient of variation of an earlier project, which had a coefficient of variation of 1.5. And then we were asked which project is more risky. Is it the project with the coefficient of variation of 1.5, or is it the project with the coefficient of variation of 1.84? And then the way it works is that the higher the coefficient of variation, the riskier the project. So in this case, the software venture with a coefficient of variation of 1.84 is riskier. So the software venture would be considered more risky because of the higher coefficient of variation of 1.84 compared to that of 1.5 of the previous venture. So please make sure you are comfortable with those calculations. They are very important for the exam. You need to be able to calculate your expected return and your variance and standard deviation for your investments. Okay. Next, let's talk about the return on a portfolio, right? So sometimes you might be asked to get the return. We've talked so far about the expected return on an individual project, and I showed you how to calculate the expected return here. And then sometimes you can just be asked to get the rate of return on an investment, right? Where they've given you the beginning value and the ending value, and we saw this example. So if you don't have probabilities, you just have beginning and ending values and cash flows, you use this approach. But if you've been given probabilities, then you use this approach. But sometimes you might be asked to determine the return on a portfolio. So remember, a portfolio is just an investment which consists of many different assets. A portfolio is just an investment in many different assets. So you might invest in property, in bonds, in shares. So that total investment of yours is called a portfolio. So the expected return on a portfolio is given by this formula. WI is the weight invested in asset I in your formula, and R bar, that line on top is a bar, R bar I is the expected return of asset I, which is found in your portfolio. We can simplify this expression for the return on a portfolio by simply saying the weight invested in asset 1 multiplied by the expected return in asset 1 plus the weight in asset 2 multiplied by the expected return in asset 2. So we just keep adding the weight multiplied by each expected return, and then the total gives us the expected return on the portfolio. So I can illustrate this to you through my own example. Suppose we have a portfolio which consists of 3 assets, asset A, B, C, and suppose we invest 200,000 in asset A, 300,000 in asset B, 500,000 in asset C, and suppose these are the expected returns associated with each of these assets in the portfolio. And then we are asked to determine the expected return of the portfolio. So to do this, we first determine the weights invested in each asset, and to determine the weights invested in each asset, we add the amounts invested and we get the total. Then we say 200,000 divided by the total to get the weight invested in asset A, 300,000 divided by the total to get the weight invested in asset B, 500,000 divided by the total to get the weight invested in asset C. So these are the different weights invested in the different assets. And then we can get the expected return on the portfolio by multiplying each weight by its corresponding expected return. So the expected return of the portfolio would be the weight invested in asset A multiplied by the return in asset A, right? Plus the weight invested in asset B multiplied by the return in asset B. Plus, so this is the return in asset B, plus the weight invested in asset C multiplied by the return in asset C. Again, just as we were dealing with probabilities when we were calculating the expected return, the variance, and the standard deviation, leave your weights as decimals. Leave your weights as decimals, right? Leave your weights as decimals, but you can put your returns as percentages. When you're calculating calculations to do with expected returns, variances, standard deviations, etc. of portfolios, you can leave the returns as numbers as they are, as percentages, but you should change the weights and the probabilities to decimals. So we get 0.9. Okay. And then, so make sure you're comfortable with this. This is also a very common question that comes up in the exam. Next, you need to know about diversification. Diversification, this is also a really important section. Okay, so diversification. So the first thing you need to note is that so far we've been talking about risk. So that total risk that we've been talking about, that risk, it can be divided into two types of risk. We have what we call non-diversifiable risk, and we have what we call diversifiable risk. So of this total risk, diversifiable risk is the first type I'll talk about. This is the portion of an asset's risk that is attributable to a firm's specific random causes and can be eliminated through diversification. And it's also called unsystematic risk. So whenever we invest in an asset or in a particular company, that company has what we call diversifiable risk. This is risk that's just associated with that particular asset or with that particular company. For example, if we invest in a bank, if there's fraud at that bank, the fraud just affects that bank only. It doesn't affect our other investments. So that fraud risk, that risk of fraud associated with the bank, is a risk that will just affect one asset out of our portfolio of assets. Let's say we've invested in many different banks, we've invested in bonds and shares. So if one thing happens at one bank, it won't affect other banks. So we call that diversifiable risk. It can even apply to other assets. It's just an event that can just affect one asset or one company. We call that diversifiable risk. And then when we invest in an asset or in a particular company, we also have non-diversifiable risk. And the relevant portion of an asset's risk attributable to market factors that affects all firms and cannot be eliminated through diversification. So non-diversifiable risk is also called systematic risk. Now this is the risk that affects all firms, it affects all companies. For example, let's say we've invested in many different banks in a particular country, and let's say there's an earthquake in that country. That's a non-diversifiable risk. It affects all the banks, or it affects all the companies we've invested in. It doesn't just affect one particular company. Even inflation or a pandemic, those are things that affect everyone. You cannot diversify away from them. They are not specific to a particular company or to a particular area of the economy. So like I said, the total risk on an asset is divided into non-diversifiable risk and diversifiable risk. So you need to know that, right? So like I was saying, diversification affects the risk of a portfolio. So when we talk about diversification, we just mean that you're holding many different assets of different types. You're just not holding assets or shares in one company. So diversification is good because it has the effect of reducing the total risk of a portfolio. So if your portfolio has many different investments in different companies and different assets, that reduces the total risk of the portfolio. And this happens by reducing the unsystematic risk. So this risk that can be removed through diversification is known as unsystematic risk. And like we said before, we also call it diversifiable risk. It can be diversified away. So diversification, this act of holding many different types of investment and assets, cannot reduce systematic risk. It can only reduce unsystematic risk. No matter how much we diversify, we cannot eliminate systematic risk, which is also known as non-diversifiable risk, because it affects everyone in the market. So this diagram below illustrates what we mean. This diagram below, it shows us this side is the risk of the portfolio, and then this is the number of securities or assets in the portfolio. And this diagram is illustrating to us that the more assets we invest in a particular portfolio, the more assets we invest in a portfolio, the lower the risk becomes. You see this graph is going down. So it's showing us that the total risk keeps decreasing as we invest more and more assets in a portfolio. But you'll notice that the part that's decreasing is the top half of the graph. This is the part that decreases. But the bottom part does not decrease. The bottom part is the part to do with non-diversifiable risk. This risk remains the same. It doesn't change as we invest in more and more assets. But as we invest in more and more assets, the diversifiable risk decreases. So the total risk in a portfolio is measured by the variance or standard deviation, and we already showed how to calculate this. In conclusion, don't worry too much about the diagram or other factors, but just remember that total risk consists of diversifiable risk and non-diversifiable risk. And diversifiable risk can be eliminated through diversification, and non-diversifiable risk cannot be eliminated through diversification. And also make sure you can give examples of the different types of risks that we have in terms of diversifiable risk and non-diversifiable risk. Next, I'm going to talk about the capital asset pricing model, right? So the capital asset pricing model, this is a model that's used to determine the required return on an asset. Remember, we said that the higher the risk, the higher the required return. So let's say we have the risk associated with an asset and we want to calculate the return we require given that risk. We can use what we call the capital asset pricing model. And it's also known as a pricing model because it can tell us if an asset is correctly priced, if an asset is expensive or cheap, or whether the price is right. So to calculate the required return using the capital asset pricing model, we use the following formula. RJ is the required return on asset J. RF is known as the risk-free rate, or sometimes they call it the return on a government bill, on a treasury bill. The return on a government treasury bill, that's RF, is the risk-free rate of return. BJ is known as the beta coefficient. It's a measure of systematic risk. It's a measure of non-diversifiable risk. RM is the market return, or the return on the market of portfolios, or the return on a market index. We've already explained what RF is. It's the risk-free rate. Okay, so this equation can help us to determine the required return. Please note, RM minus RF, this part is known as the market risk premium. So if you get a question for the capital asset pricing model and they give you the market risk premium, it means they've already subtracted these two for you. They've already done the calculation for this part for you. So always read carefully. There's a difference between a market risk premium and a market return. Those are two different things. Okay. Then please note this risk-free rate can be broken down into two parts. The risk-free rate is given by R star plus IP. R star is known as the real rate of interest, and IP is known as the inflation premium, or the expected inflation. So the return on an asset can also be written as follows. the nominal return on an asset. If we write it in terms of the real rate of interest and the inflation premium, the nominal return on the asset is given by R star plus IP, the inflation premium, plus the risk premium. So this is the answer for, sorry, this is the calculation for what we call the nominal return. So these equations, I know they can be a bit daunting, but the more you practice with them, the more you become familiar with them. So we can look at a simple example in which you need to use the inflation premium and the real rate of interest to calculate the expected level of inflation, just to illustrate how some of these relationships might be used. The risk-free rate on treasury bills was recently 8.7%. If the real rate of interest is estimated to be 4%, what was the expected level of inflation? Right. So they want us to calculate the inflation premium. So we can take this relationship right here, this one, to help us to calculate the inflation premium. We say the risk-free rate is equal to the real rate plus the inflation premium. Risk-free rate is 8.7%. Real rate is 4%. And then we take 4% to the other side to say 8.7 minus 4%, giving us an inflation premium of 4.7%. And then the last thing I just want to talk about is beta. Remember, we've talked about beta. So I was just taking you through each part of this capital asset pricing model and questions they could ask. I just showed you how sometimes they could ask questions associated with the risk-free rate of return, right? So let's talk about beta. So beta is a measure of systematic non-diversifiable risk of an asset. So this beta that we find in the capital asset pricing model, it's a measure of systematic risk. It's a measure of non-diversifiable risk. Beta is a measure of the systematic non-diversifiable risk of an asset. It measures the movement of a company's share relative to the market. A beta of 1 means that the share price will move with the market. A beta greater than 1 means that the share will be more volatile than the market. A beta of less than 1 means the share will be less volatile than the market. So remember, beta is a measure of how risky an asset is relative to the market. So what we are saying that it's a measure of non-diversifiable risk. So we are saying that if a share has a beta of 1, it means it's got the same risk as the market. If a share has a beta which is greater than 1, it means that the share has more risk than the market. Volatile just means more risk. And if a share has a beta less than 1, it means that the share has less risk than the average market. Okay, so please make sure you know how to interpret beta. So beta measures the systematic risk. Beta measures the risk that cannot be diversified away by holding a share, any asset or portfolio. We can calculate the beta not only of a share but also of a portfolio. So let me illustrate how you would calculate the beta of a portfolio. To get the beta of a portfolio, we would use the same approach we used to calculate the expected return of a portfolio. You just take each weight invested in each asset and you multiply it by its corresponding beta, and then you add them up, and that gives you the beta of the portfolio. Okay, so we can look at an example as we conclude. Sider's Investment Account Club has only 2 shares in its portfolio. So this is from October, November 2019, question 33. So there's a portfolio that just has 2 shares, 65,000 invested in a share with a beta of 0.7 and 35,000 invested in a share with a beta of 1.3. What is the portfolio's beta? So again, we first have to determine the weights. Share 1 is 65,000 invested, share 2, 35,000 invested. We add these two together, we get a total of 100,000. 65,000 divided by 100,000 gives us the weight invested in share 1. 35,000 divided by 100,000 gives us the weight invested in share 2. And then we just take each of those weights multiplied by their beta values. Share 1 multiplied by its beta of 0.7 plus weight of share 2 multiplied by the beta 1.3, and that gives us the beta of the portfolio. So that brings us to an end of this recording. Thank you for listening. I hope the recording has been helpful. As homework, I would like you to try the following questions: October, November 2019, question 31, May, June 2019, question 19, 38, and 29, and May, June 2019, section B, question 1. So these are just some practice questions to help you to go through what we've done so that you understand it better. And then in the next recording, I'll take you through the solutions, and then we'll start looking at the last section, which is share valuation. I think we might need to cover this. I'm sure I'll be able to cover it in one recording, if not maybe 2, and then we'll be done. So thank you very much for listening to the recording. I hope it's been helpful. If you have any questions or queries, please feel free to let me know. I won't always be able to get back to you, but I'll try to get back to you as soon as I can. Thank you once again.